Imagine a company perfectly positioned to ride a historic wave, with gold prices soaring. But what if the market's excitement has raced so far ahead? Well, what if the fundamentals are telling a completely different story? Today, we're diving deep into Gold Fields Ltd, NYSE ticker GFI, and we're about to unpack is far more complex and frankly more contradictory than maybe the headlines suggest. Welcome to the deep dive. This is where we take a whole stack of sources, articles, research, our own notes, and really try to pull out the most important nuggets of knowledge, insight, cutting through the noise to help you get truly well-informed. So our mission today is to uncover the crucial insights from all this material and understand what truly matters for this mining giant. And just for context, this analysis is current as of August 13th, 2025, with GFI stock closing at $31.37.
Right. And for those of you following GFI closely, Gold Fields is actually set to release its H1 2025 earnings on August 22nd, 2025. So you'll definitely want to stay tuned because we will be covering those results for you pretty much within minutes of their release.
Absolutely. Good point. Now, to make this deep dive as clear and impactful as possible, we've broken it into two parts. So in part one, we'll cover the core business, the management, and the financials. Specifically, that's Chapter 1, Business Analysis, Chapter 2, Management Evaluation, and Chapter 3, Financial Analysis. Then in part two, we'll shift our focus to market perception, ownership, and risk. We'll move into Chapter 4, Market Sentiment, Chapter 5, Ownership Structure, Chapter 6, Risk Assessment, and then finally, Chapter 7, Conclusion. Okay, let's kick off with part one and our first segment, Chapter 1, Business Analysis. Gold in 2025 has truly reasserted its role as, the ultimate safe haven asset, hasn't it? Prices surging to generational highs. This should create a kind of golden era opportunity for miners like Gold Fields.
It's an incredible macroeconomic tailwind, absolutely. But what's fascinating here is that despite this, Gold Fields is navigating a really complex web of internal operational hurdles and also external geopolitical pressures. So the core question for you, the listener, is whether GFI can truly convert this historic gold bull market into lasting shareholder value, or if, execution risks will ultimately tarnish this golden opportunity.
Okay, so let's unpack their core business then. Gold Fields is globally diversified, vertically integrated, basically a precious metals producer. They cover the entire mining value chain, starting with exploration, then extraction, both underground and open pit, and then processing to produce these semi-pure gold doré bars and also copper concentrate.
And their revenue, it overwhelmingly comes from those sales, which means their financial performance is highly leveraged to gold and copper prices, and also USD exchange rates, especially against the South African rand and the Australian dollar. It's quite sensitive. Last year, GFI pulled in over $5.2 billion in revenue, a solid 16% jump. But here's the kicker.
There's always a kicker.
Right. That growth was almost entirely thanks to soaring gold prices, a 25% surge, which actually masked a 10% drop in actual gold production. So for you, the listener, this clearly shows just how dependent they are on commodity prices right now, maybe less on their own output improvement.
Okay, so gold is clearly the main event, but they also have significant byproducts like copper concentrate. I think you mentioned from their Cerro Corona mine in Peru. And silver, too. And they're a massive player on the global stage, right? Market cap around, $28 billion?
Exactly. $28.18 billion as of our cutoff date. And GFI has this deep corporate lineage founded way, way back in 1887 by Cecil Rhodes, so one of the oldest in the game. They operate 9 active mines and 1 major development project across 6 countries: Australia, Canada, Chile, Ghana, Peru, and South Africa. Quite the footprint. For 2025, the company's guidance is for 2.25 to 2.45 million gold equivalent ounces, and that's backed by 44.3 million ounces of proved and probable mineral reserves, which provides over 14 years of production visibility. Pretty substantial.
So from an investor's point of view, their value proposition seems pretty straightforward. You get direct, unhedged exposure to gold prices, managed by a seasoned operator with this diversified portfolio, plus a commitment to shareholder returns through a consistent dividend policy. Seems simple enough on the surface. Okay, shifting focus a bit to the industry itself. What are the key market trends really driving these gold prices right now?
Well, the drivers are incredibly robust. We're definitely in a powerful, sustained gold bull market in 2025. Spot prices surged to $2,750 an ounce, and some forecasts are even suggesting $4,000 an ounce by mid-2026. Now, this is fueled by Well, a few things. Strong demand from retail and institutional investors looking for that safe haven against inflation and geopolitical risk. Also, mounting fiscal deficits in major economies, which tends to pressure the U.S. dollar. And significantly, central banks are buying a lot of gold to diversify their reserves. So yeah, this high price environment is a major tailwind for GFI.
It certainly looks like a golden era for miners. But is there a point where these soaring prices become a bit of a double-edged sword, maybe inviting more competition or, I don't know, less discipline?
That's a great question, actually, and it ties right into the competitive landscape. GFI, with its, $28-ish billion market cap, sits firmly in the top tier of global producers, comparable to AngloGold Ashanti, maybe, though still smaller than giants like Newmont. But the barriers to entry in large-scale gold mining are just immense. We're talking billions in capital, years of complex permitting, geopolitical risks, and just the sheer scarcity of new, economically viable discoveries. That does provide a protective moat, you could say, for established players like Gold Fields.
Right, and as a global operator, GFI has to navigate this labyrinth of regulations. What does that actually mean for them day to day?
It means constant vigilance, really. South Africa, for instance, is notoriously difficult, inefficient sometimes. There's policy uncertainty and, frankly, an often antagonistic relationship with the mining ministry. Australia is more stable, sure, but permitting is taking longer and longer. Ghana. Well, the government has a 10% legal interest, which directly influences things like the demo mine lease renewal. These aren't just bureaucratic hurdles. They directly impact costs and operational flexibility.
So what's GFI's real competitive edge then? It can't just be about digging gold. You mentioned that long history.
Exactly. That 1 in 35-plus year legacy isn't just a historical footnote. It translates into tangible advantages. Think easier access to capital markets, attracting top talent in a really tough industry, and just being a known, trusted name. They actively nurture this through investor engagement and, importantly, robust ESG performance, which is essential for operating in sensitive areas today. Their scale also allows for significant cost advantages, greater purchasing power for big machinery, services, plus centralized expertise. Their strategy targets low-cost, longer-life assets. Like that proposed JV, though it's paused now with AngloGold Ashanti in Ghana. The aim was Africa's largest gold mine, with costs below $1,000 an ounce.
Okay. And as you said, being a commodity producer, things like network effects or switching costs, they don't really apply here. Gold is gold.
Precisely. Gold Fields' most significant unique advantages are, first, that geographic diversification, Australia, Africa, the Americas, which helps mitigate single-country political and operational risks. Second, that vast long-life mineral reserve base we mentioned, 44.3 million ounces, that gives them over 14 years of production visibility. And third, despite some recent issues, they do have deep technical and operational expertise for complex projects like the very challenging South Deep mine in South Africa. But, and this is really important, here's the paradox we've really honed in on. GFI's diversified portfolio, which is a core strength, right? It's also the source of its greatest current weakness, which is operational complexity and execution risk. We've seen recent kind of unrelated problems across their global footprint, persistent backfill and stope access issues at South Deep, severe weather hitting Gruyere in Australia, and ramp-up delays at Salares Norte in Chile, including, believe it or not, freezing risks.
Right. So geographic diversification spreads the risk, but it also brings in this high degree of operational complexity. It sounds like the investment thesis now hinges less on where the gold price is going and much more on management's ability to actually demonstrate consistent, reliable execution. That moat is only as strong as its efficient, predictable operation, maybe.
Okay, we've unpacked the business model and the market forces, which, yeah, on the surface, look like a golden opportunity. But as we hinted, GFI faces these significant execution hurdles. So the crucial question becomes, who's steering the ship?
Let's turn our focus now to the leadership team. This is Chapter 2, Management Evaluation. GFI is currently under new leadership, right? Mike Fraser became CEO January 1, 2024.
That's right. And Fraser brings extensive senior leadership experience from global mining giants like BHP and South 32. So, on paper, he seems well-equipped for multinational operations like this, but his immediate test was, well, a series of significant operational crises in 2024, including, tragically, fatalities at both South African and Australian operations.
Given those really significant operational setbacks and the tragic incidents, how effective has the new leadership truly been? Has their response gone beyond just PR, do you think, or are we looking at maybe deeper systemic issues?
Well, they've certainly been public about their response. They announced a group-wide review of safe-to-culture, a specific recovery plan for South Deep's backfill issues, and a technical review at Solaris Norte for that freezing mitigation. So actions are being stated. However, you have to look at the company's longer-term track record, which is mixed. There were past tailings dam incidents, those ongoing struggles with South Deep's geology, plus that abandoned Yamana acquisition back in 2022, which was seen as a significant strategic setback. On the positive side, though, GFI generally maintains a high standard of communication. The reports are detailed, they openly discuss challenges, and Sustainalytics rates their management of material ESG risks as strong. So, some points there.
Okay, now on to capital allocation. GFI's priority seems clearly focused on investing in its existing assets. Significant capital going into sustaining CapEx and brownfield exploration. For 2025, their total guided capital expenditure is pretty substantial, right? Between $1.49 billion and $1.55 billion.
It is substantial. And following that failed Yamana bid, their M&A strategy has definitely recalibrated. The focus now seems to be on smaller, more strategic bolt-on acquisitions, like acquiring the remaining stake in the Windfall project in 2024. They also take strategic minority stakes in junior exploration companies, kind of for future optionality.
And shareholder returns, primarily through dividends, not so much buybacks. I think the data showed a negligible buyback yield, even a slight share count increase from stock-based compensation.
That's right. In contrast, their dividend policy is quite clear and consistent. They aim to pay out 30% to 50% of normalized earnings semi-annually, and the current payout ratio is a pretty healthy 32.22%, which seems quite sustainable at current earnings levels.
Okay. Now, for the trailing 12 months, GFI generated a return on invested capital, ROIC, of 16.85%.
Right, 16.85%. But here's that critical puzzle piece we talked about earlier. GFI's ROIC is 16.85%, okay?
Yeah.
But when you compare it to their cost of capital, their WACC, well, we hit a major snag. Depending on how you calculate WACC, and we found sources with very different numbers, one saying 18.06%, another 12.91% Gold Fields is either destroying value with every new investment or maybe just barely creating it. This isn't just some academic numbers game for analysts. For you, the listener, it fundamentally questions whether GFI can truly turn this gold boom into lasting shareholder wealth. It puts immense pressure on management to prove their efficiency.
Right, that ambiguity is concerning. Okay, let's transition then to Chapter 3, Financial Analysis. Let's get a quick snapshot of GFI's key metrics as of today, August 13, 2025. Share price 31.37 sats, market cap over $28 billion. And for the trailing 12 months, GFI reported $5.2 billion in revenue and $1.25 billion in net income.
Yeah, and their TTM price to earnings ratio, the PE, stands at 22.64. But interestingly, the forward PE is much lower at 10.09. That suggests analysts are expecting pretty strong earnings growth ahead, which would bring that multiple down significantly. Their dividend yield is currently 1.42%, the debt-to-equity ratio is 0.57, and the current ratio is 1.13.
Okay, looking at revenue growth trends over the past 5 years, GFI has shown pretty strong and actually accelerating growth.
It has, but again, this is largely due to increased production and, more critically, that rising gold price. It just highlights its high sensitivity to commodity prices. Their profit margins look robust, but they are volatile. They depend directly on that spread between the gold price they receive and their operating costs. We saw some margin compression in 2022-2023 due to inflation hitting costs, but then a strong recovery in 2024 as the gold price surge really outpaced those cost increases.
And free cash flow generation. Consistently positive over 5 years, but highly volatile.
Yeah, that volatility is pretty characteristic of the capital-intensive mining industry. You know, large investments like that big Solaris Norte project they're building cause these swings. We did see a sharp increase, though, to $421 million in 2024, which reflects that improved profitability compared to the lower figures in the prior few years. Now, regarding financial stability, their earnings consistency, well, it reflects the cyclical commodity markets. They had some significant net losses in past weaker gold price environments like 2015, 2017, 2018. However, since 2019, which kind of coincides with the start of this current bull market, earnings have been consistently positive and have grown substantially. Net income went from $162 million in 2019 to $1.25 billion in 2024.
So that's positive in a favorable market, definitely. But it's crucial to remember that underlying cyclicality, right? Now, their debt-to-equity ratio is 0.57.
Which is generally seen as manageable, but it is higher than the industry median, which is around 0.145. So it suggests a somewhat more aggressive debt strategy compared to peers. It has also trended upward from 0.35 back in 2022, so that warrants monitoring.
And the current ratio at 1.14.
Okay, so that means they have about $1.14 in immediate assets for every dollar of short-term debt. So yes, technically they can meet their immediate obligations. But here's the flag for you. That's well below the industry median of 1.84, and it's a significant decline from 2.29 back in 2022. It definitely signals a tightening in their short-term liquidity, something to keep an eye on.
Right. But on dividend stability and growth, GFI seems to have a strong track record, returning capital through reliable semi-annual dividends, especially during this recent period of high profitability.
Indeed. We've seen a really substantial increase in their annual dividend payments since 2019. Actually, an impressive 5-year annualized growth rate of 35.88%. That demonstrates a clear commitment to shareholders. You have to give them that.
Okay, now for the tricky part, valuation analysis. On a relative basis, looking at the PE ratio, GFI appears to be trading at a premium. That TTM PE is 22.64, which is significantly higher than its own recent history.
Yeah, it peaked around 17 back in 2020, was as low as 11.4 in 2022. Compared to direct competitors, it's at a premium to, say, Barrick Gold and Harmony Gold, but maybe a slight discount to Agnico Eagle Mines. However, as we noted, that forward PE of 10.09 does suggest analysts expect strong earnings growth to bring the multiple down going forward. But what about intrinsic value? Using a discounted cash flow or DCF model, which tries to determine value based on future free cash flows, an educational model calculates an intrinsic value for GFI of approximately $22.32 per share.
Okay, $22.32, which is about 29% below the current market price of $31.37. That suggests pretty significant overvaluation on a fundamental basis. In this model, what are the key assumptions? It uses a discount rate, WACC, of 7.9%.
Yeah, and that's a crucial point. That 7.9% comes from an internal company valuation source. It's much, much lower than external calculations we saw, which ranged from 12.9% all the way up to 18.1%. If you use a more conservative, higher discount rate, which many would argue is appropriate given the risks, you'd get an even lower intrinsic value, making that gap between price and value even wider. The model also assumes 2.5% terminal growth, a long-term gold price of $2,100, which is well below current spot, but maybe reasonable long-term and around 8% revenue growth near term.
So we got this real puzzle here when we look at valuation. On one hand, strong market momentum, bullish analyst ratings, but on the other, a fundamentally expensive stock based on PE history and that DCF.
Exactly. And the disconnect is further highlighted by the analysts themselves, which is fascinating. Despite that overall strong buy consensus rating, the average 12-month price target is $30.08, which, as you noted, is actually below the current share price. This is just a classic warning sign for you, the listener. It really suggests the market pricing is maybe based more on gold price euphoria than on sustainable earning power. It leaves a very, very thin margin of safety.
Okay. And that wraps up part 1 of our deep dive on Gold Fields. Stay with us. We'll be right back after a short break to shift gears into part 2, where we'll explore market sentiment, ownership, and those key risks. Welcome back to the deep dive. We're now moving into part 2 of our analysis on Gold Fields Ltd. Let's jump straight into chapter 4, market sentiment. So the prevailing sentiment among Wall Street analysts is officially a strong buy.
Right. But here's that contradiction again. Despite the strong buy rating, the average 12-month price target is $30.08, which again is a nasty 3.87% downside from the current $31.37 price. This discrepancy is just such a clear red flag. It really suggests analysts, even the bullish ones, think the stock has reached or maybe even exceeded its near-term fair value. Now, the general media tone surrounding GFI has been pretty positive, largely driven by the strong gold market. We saw a sentiment score of 1.26 out of 5, indicating, moderately positive, but maybe not overwhelmingly euphoric media perception. Recent headlines focus on GFI benefiting from the gold run, new buy ratings, that kind of thing. But you also see cautious reports highlighting the operational hurdles and, importantly, valuation concerns after the price run-up.
Okay, turning to the actual market indicators. Short interest seems exceptionally low.
Yeah, very low. Only about 4.25 million shares shorted, which is just 1.4 days to cover. That indicates a near total absence of bearish conviction from short sellers. They're not betting against it right now. And the technical indicators, they are overwhelmingly bullish. The share price of $31.37 is significantly above its 50-day simple moving average, which was around $25.19. That signals a strong short to medium-term uptrend.
And reinforcing that, the price is also substantially above its 200-day simple moving average, which was down at $22.37. That's a classic indicator of a strong and sustained bull market, isn't it?
It absolutely is. So the combination of these market indicators, low short interest, price, way above moving averages, it paints this picture of classic bullish euphoria, driven almost purely by momentum, it seems. However, you have that crucial counter evidence from the analyst price targets themselves. Professionals believe the price has detached from the underlying value. So for you, the listener, this is a classic Mr. Market scenario. Imagine the market as that overly optimistic friend at a party full of exuberance, maybe not entirely grounded in reality. While you can sometimes ride that wave for a bit, the risk of a sharp turn, a correction, is definitely elevated, especially when there's so little fundamental safety net underneath.
Okay, interesting analogy. Let's move on to Chapter 5, ownership structure. GFI has a high degree of institutional ownership, right? Around 62.5% of shares. It's fairly typical for a company of this size.
Yes, it is. The top institutional holders include names like Venek, the Vanguard Group, and 91 UK Limited, each holding around 3–4%. Ownership is relatively concentrated, too. The top 25 shareholders own over 52% of the company. Now, that can provide stability, but it also carries risk if one or two large funds decide to liquidate their positions.
Right. But in stark contrast to that high institutional ownership, insider ownership is exceptionally low, just 0.095% collectively. CEO Mike Frazier, for example, owns merely 0.009% of the company. That seems tiny.
It is strikingly low. And adding to that, there has been no recent insider trading activity, no purchases, no sales. So insiders aren't really signaling confidence or concern with their own capital right now. That significant concentration among a small number of large institutions means their collective view heavily influences GFI's strategic direction and governance. But this extremely low level of insider ownership, well, it's a critical red flag for value investors. It really deviates from that ideal governance structure championed by people like Warren Buffett, the whole skin in the game philosophy. When management's financial interests aren't deeply tied to long-term per share value through direct stock ownership, it creates a potential agency problem. Are they focused on short-term bonus metrics? Or maybe empire-building moves like that Yamana bid? It raises fundamental questions about whose interests are truly prioritized in key capital allocation decisions.
Yeah, that lack of alignment is definitely something to think about. Okay, let's move into Chapter 6. Risk assessment. We can use the SWOT framework here. Strength, weaknesses, opportunities, and threats for Gold Fields.
Okay, starting with strengths. As we've discussed, Gold Fields boasts that geographically diversified portfolio with long-life assets, which reduces single-country risk. It has a large, high-quality reserve base, ensuring long-term visibility. It generally maintains a strong balance sheet and has that established brand and history dating back to 1887, providing significant credibility.
Okay, on to weaknesses. We've touched on these too. There's that recent history of operational execution risk, missed targets, cost overruns at key assets like South Deep and Solaris Norte. They also have high sensitivity to operating costs, making them vulnerable to inflation in labor, fuel, power. That lack of insider alignment, with less than 0.1% ownership by senior management, is a serious governance concern. And their portfolio is capital intensive, requiring significant ongoing investment just to stand still, almost.
Right. Now, for opportunities. The historic gold bull market is obviously a massive tailwind. That potential for gold to hit $4,000 an ounce is a huge opportunity if it happens. The ramp-up of the new Solaris Norte mine in Chile is a clear potential catalyst for a production boost and hopefully lower overall costs. There's also significant operational turnaround potential, especially if they can finally crack the code at South Deep. And the company's disciplined approach to value-accretive bolt-on M&A could unlock further value down the line.
And finally, the threats. Geopolitical and regulatory risks are just constant in this business, particularly potential adverse changes in South Africa and Ghana resource nationalism, political instability, adverse macroeconomic shifts like a sharp rise in real interest rates or a very strong U.S. dollar could put pressure on gold prices. A very specific and immediate threat is those new U.S. tariffs on South Africa, which we need to dig into. And of course, repeated failure on guidance or costs could seriously erode investor confidence over time. Okay, let's talk more about those macro factors. GFI's business seems acutely sensitive to both inflation and interest rates.
It really is. Inflation is a classic double-edged sword for them. High inflation generally drives gold prices up, boosting revenue, which is good. But it's also a powerful headwind to GFI's costs: labor, fuel, energy, steel, you name it. If costs rise faster than the gold price they realize, profit margins can get severely compressed very quickly. As for interest rates, well, gold typically has an inverse correlation with real interest rates. As a non-yielding asset, gold becomes less attractive when returns on things like bonds are higher after accounting for inflation. So aggressive rate hikes by central banks could put significant downward pressure on the gold price and therefore on GFI's revenues and profitability.
Right. And speaking of specific geopolitical factors, you mentioned a really material near-term threat has emerged, those U.S.-imposed tariffs in 2025.
Indeed, this is a big one. The United States imposed a 30% tariff on all goods imported from South Africa, effective August 7, 2025. This poses a direct and significant threat to the profitability of GFI's sole remaining South African asset, the South Deep mine. It could potentially turn what's already a challenging operation into a value-destructive one.
Wow, 30%. That creates a uniquely fragile profile for South Deep, doesn't it? It's already known to be operationally complex, high cost, and it's operating in what you described as a difficult and deteriorating South African regulatory environment.
Exactly. The tariff creates a kind of perfect storm of negative factors converging on South Deep. It dramatically elevates the risk that this mine becomes a significant drag on the company's overall performance and valuation. So, for you, the listener, the valuation of GFI must increasingly be considered perhaps on an ex-South Deep basis, with that South African asset potentially representing more of a growing liability than a core asset right now.
That's a sobering thought. Okay, let's bring it all together now for our Chapter 7, conclusion. Can we synthesize our findings, maybe starting with the bull case?
Sure. The bull case is clear, and it's compelling on the surface. GFI is a large, unhedged gold producer. That makes it a primary beneficiary of this historic gold bull market we're seeing, which is driven by inflation fears, central bank buying, geopolitical instability. It has a high-quality, geographically diversified portfolio, and management has shown a strong commitment to shareholder returns via dividends. Plus, the successful ramp-up of the potentially low-cost Salares Norte mine is a clear catalyst for growth if they execute well.
Okay, but the bear case seems equally compelling, if not more so given the current price. At its current share price, GFI appears significantly overvalued based on historical metrics and our DCF analysis, showing basically no margin of safety. It has a concerning track record of recent operational missteps, misguidance, cost overruns. It faces substantial geopolitical and regulatory threats, especially now in South Africa, with that crippling 30% U.S. tariff hitting South Deep. And finally, that extremely low insider ownership indicates a potentially weak alignment between management and long-term shareholders.
Right. And just to reiterate that valuation point, our disciplined educational DCF model, using what we consider conservative long-term assumptions, estimates an intrinsic value for Gold Fields Ltd. Of approximately $22.32 per share.
So as of August 13th, 2025, GFI's share price of $31.37 represents a substantial premium, about 41% to that estimated intrinsic value. So while GFI certainly has high-quality assets and is benefiting from a powerful gold bull market, the current valuation seems to be pricing in not only all of this optimism, but also a degree of operational perfection that, frankly, the company has recently struggled to achieve. That significant disconnect between the market price and the underlying fundamentals, combined with those operational execution risks and the specific geopolitical threats like the tariff, well, it strongly suggests that a sufficient margin of safety for a new investment at current levels simply does not exist.
You know, when the market's enthusiasm runs so far ahead of a company's fundamental value and its operational realities, it really makes you wonder, doesn't it? Are we observing a golden opportunity here, or is it more like a gilded trap? How will you, the listener, approach the challenge of navigating such powerful market momentum when it's set against the backdrop of this underlying financial gravity? Something to think about.
Indeed. Thank you for joining us on this deep dive into Gold Fields Ltd. If you found this analysis valuable, we'd really appreciate it if you could like and subscribe to the Stock Analytics AI YouTube channel. It helps us a lot.
Absolutely. And remember, members get priority deep dives on tickers they suggest for just €4.99 a month. Plus, over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those analyses. And if you just want a one-off deep dive on a specific stock you're interested in, just drop us a super thanks on YouTube.
That's right. And members can add their stock suggestions for future deep dives right there in the comments, and we will definitely pick them up.
And just the usual but important reminder. Please remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Until next time, keep digging for those insights.